Kalshi has just doubled down on commodities, signaling a pivotal shift for digital markets and everyday investors. In a year when inflation hedges and supply chain chokes dominate headlines, a dedicated commodities hub could change how people trade real assets with real liquidity. The headlines promise broader access to grains, metals, energy, and soft commodities backed by an exchange that operates within a regulated framework. For newcomers and seasoned traders alike, this matters because it could turn forecasts into tradable positions overnight rather than over weeks through complicated intermediaries. The implications stretch beyond niche traders into broader price discovery and risk management. At its core, Kalshi is expanding from binary event contracts to a broader suite of commodity contracts. The company announced a market expansion that will add more tradable instruments across energy, metals, agriculture, and soft commodities, all housed in a new dedicated hub designed for faster onboarding, improved liquidity, and clearer pricing. Traders will be able to place bets on price moves, supply disruptions, or seasonal patterns without owning the underlying asset. Think of it as a regulated exchange where you can speculate on wheat prices or oil inventories with simple buy and sell buttons, rather than complex futures margins. To understand why this matters, consider how derivatives and event markets evolved. Kalshi emerged as a digital exchange after regulation, offering binary contracts on real-world events, akin to a modern version of spread betting, but with clearer legal guardrails. The commodities market has long relied on futures, swaps, and over-the-counter instruments that require brokers and margin capital. Kalshi's pivot to physical assets echoes a broader trend. Retail investors seeking direct exposure to price moves, not merely hedges against risk. Past players like CME and Intercontinental Exchange built scale, liquidity, and rating credibility. Kalshi hopes to thread a more accessible path. Analysts say the announcement could deepen liquidity for commodity derivatives and attract a wave of retail capital. Trading volumes in related instruments have surged on news of expansion, with spreads tightening as new participants anticipate faster execution and lower friction costs. Exchanges expanding into new markets often lead to more parallel products, such as weather contracts or supply chain risk hedges, creating a more vibrant pricing environment. Critics warn about crowded trades and potential overconfidence in models. Still, benchmarks like crude oil, copper, and corn show reaction spikes that mirror NFT and meme stock IPO fervor, albeit anchored in real assets. Beyond Kalshi, the policy change ripples through brokers, asset managers, and hedge funds watching volatility as a potential revenue stream. Retail brokerages might add easy access to commodity bets, while traditional futures desks reallocate capacity to capture new liquidity. Agricultural producers could see more accurate price signals that help with planning, while energy firms monitor bid-ask dynamics for hedging costs. ETFs and mutual funds could layer new derivative products, attracting customers seeking targeted exposure without owning physical stockpiles. Retail traders curious about inflation hedges join communities discussing contracts on weather, metal supply, and crop yields for the first time today. Macro forces loom large as commodity markets respond to policy shifts, inflation data, and supply chain headlines. Kalshi's expansion coincides with fiscal stimulus debates, China energy demand, and OPEC output adjustments that push benchmark prices higher. A newly price-sensitive retail crowd looks for hedges against currency depreciation and budget stress at home, while corporations evaluate cost of capital amid rate volatility. Central banks monitor market structure changes as a potential channel for risk transfer. In this environment, liquidity providers weigh capital commitments against regulatory uncertainty, and cross-border traders track time zones, settlement rules, and data feeds for reliability. Smart money is watching the Kalshi move with cautious optimism and rigorous risk controls. Institutions are piloting small commodity sleeve allocations, running scenario analyses, and layering risk budgets to test regulatory and operational frictions. Some hedge funds are profiling event-based hedges linked to weather disruptions and crop yields, while pension funds weigh long-horizon inflation sensitivity against liquidity requirements. Retail sentiment clusters around simple, digestible contracts with clear settlement logic and transparent fees. Traders compare Kalshi expansions to the early days of ETFs, hoping quicker access, lower costs, and the ability to express views on real-world supply dynamics. Any expansion carries risk, and skeptics point to overexposure, data integrity, and regulatory fatigue. If liquidity grows too fast, bid-ask spreads may widen in stressed markets, harming reliability for risk management. Concentration could shift from established futures players to new entrants, amplifying systemic shocks during abrupt price moves. The dedicated hub may tempt speculative behavior, creating crowded trades that retreat when volatility spikes. Operational hiccups, settlement delays, or mispriced contracts could trigger reputational damage for Kalshi and erode trust in regulated event markets. Finally, geopolitics and commodity supply shocks remain unpredictable, reminding investors that hedges are imperfect. In practice, retail investors can approach this expansion with disciplined steps. Start by testing small allocations in familiar assets, using demo accounts or small real trades to learn how Kalshi pricing behaves during news flow. Diversify across contracts that hedge real exposures you already carry, such as energy or grain price risk, rather than chasing hype around a single contract. Establish clear risk limits, set stop-loss analogs, and avoid disproportionate bets on one event. Track liquidity metrics, fee structures, and settlement reliability over several weeks. Finally, pair contract bets with traditional research, focusing on credible data and transparent market narratives globally. Looking ahead, Kalshi's Commodities Hub could redefine price discovery by weaving retail curiosity with institutional discipline. If the market unlocks more liquid, accessible contracts, expect tighter bid-ask spreads and quicker reactions to supply shocks, weather events, and policy shifts. The risk is simply overconfidence in models and the lure of crowded trades that collapse when volatility spikes. For investors, the path is education first, small experiments second, and ongoing risk management third. Track regulator signals, platform updates, and data quality as you build a framework. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.